with issue or something like that. The recording has not yet started.
No, sir, it is started.
But on my screen, it is showing as a record is not. The stop recording is okay. Now now it is showing to me. Okay, now stop recording is an option. Okay, great. Now it has started. All right. So let's go back to the book now. This is so irritating, actually. This stuff. Anyway. So we had that. This is where we ended the other day when Mayank asked this question about. This comparing the returns. He was not happy with the returns on the US Treasury. Well, not much you can do about that. This is what the market is happy with. So we go on from there, okay? And we were talking about the investment operation definition being subjective, which is we are on page 32. So just look out for these kinds of definitions which are not precise. This is the definition given in security analysis, and these are not precise definitions. And he's gone on here. There's not much to discuss here, actually, because he's just gone on and on about this, what is investor and the, use of the term investor. These are not really that important, actually. Reckless investor, these are not really, this is because he's a little bit emotional about this whole investor versus speculator thing. There's actually no difference, okay? This is one of those things that happens in the world where the people talk about it a lot as if there's a difference between, this is the conventional wisdom, that there is some kind of difference between speculation and investment. So what I will tell you is that this is all garbage. There is no difference between speculation and investment, okay? Everything is speculation. Everything in life is speculation because most of it is basically we don't know what's going to happen in the future. So because we don't know what's going to happen in the future, everything is speculation. Don't fool yourself that just because you're doing some solid analysis, you spend 20, 30 hours doing some analysis of a stock, it means nothing really because the future is so uncertain and it's so erratic that boom, everything can just go for a toss. So I mentioned this to you the other day, what makes investing very different from other professions like being a lawyer or an accountant. There, your value, you can extract full value for your time. You put in 20 hours, you build the client for 20 hours, everything is nice and good. In investing, it's much more erratic, okay? So this is a very important thing that this is not a precise definition, okay? So it's very important to understand that in your mind that when people talk about investing versus speculation, these are all warm and fuzzy kind of statements, and they're not precise definition. And everything is actually speculative because nobody knows what's going to happen in the future. All right. So we just try to go to the next note that I have made. I'll just click through here. All this you can read. You can read all this because you should read the book. But you get a sense of what happened in the past. That's also important. It's important for you to know the history of the stock market, especially in the US, because it's such a big economy. So investment and speculation, who wants to join? 1 minute. Ritvik wants to join. Again, also from outside Delhi School of Business, but I have admitted him. Okay, so Ritvik needs to hang on desperately till the end of the class so that I can mark his attendance as present. Okay, so all right, so this distinction between investing and speculation, he goes on and on about that. My next note is really no, Ritvik, you can raise your hand later. We'll do it later, okay? We're not going to do attendance right now. We'll do it at the end of the class. So what we have said is, okay, what indicates that no longer such as this, whatever, all this you can read on your own. There's not much to talk about here. Intelligent speculation, intelligent investing, all this. These are all, loose statements, not very precise. So you can read, but you should read all this. Just try to see what he's trying to say. And again, you'll see through and through. One of the things you'll notice that this guy is basically a mean reversion guy because he's a value investor. So all his statements are very mean reversion oriented statements. So that does not mean that he's necessarily right and that's the only viewpoint. Okay, that's the important thing. So one of the important things I focus on when I teach is that you must always cover all the scenarios. So just because you favor a particular point of view, like let's say I favor technical analysis, but I should also teach my students that there's something else called fundamental analysis also. Okay, so if I just teach my students about technical analysis, that's not really correct. And this guy is writing a book, so it's like he's teaching students. So he should not be mentioning only one side of the story. He can say that I prefer this side, but you'll notice here that in every, he doesn't even, he actually trashes momentum investing, which is not really true at all. I mean, momentum investing could have done so well for many years. I showed you the chart of Alphabet. You see Alphabet. Now, who would say that momentum investing is useless? Look at this chart of Alphabet. Okay, can you imagine how much money you would have made here? And just not just here, but all over, throughout the history of Google. Actually, look at how it's gone, especially here from after the pandemic, and see how it has risen. So, I mean, how can you say that momentum investing is all garbage? It's not. Everything requires care and precision. These are very dangerous games to play. Playing the market is a very dangerous game. And so you have to be very careful. It's like skydiving, you have to take care. You have to, check your equipment and all that. So that's what it is. So you'll notice, one of the things you'll notice when you read this book is that he's always pushing for the mean reversion approach, which is what he's saying here. That's the time to, when the market has gone up, that's the time to think about taking money out of your speculative fund, which is basically saying that, it's mean reversion. So because it's gone up so far, so much, then it should fall. Okay, that's basically, that's a mean reversion. So you should be able to recognize when I read this book, when you read this book, because I've taught you about the different philosophies, the two different philosophies, mean reversion and momentum. You should be able to recognize that this guy is pushing mean reversion, and immediately a warning bell should go off in your head that there is also another approach, which is momentum investing, which is a perfectly legitimate approach. And it's a matter of what you choose. Okay, it's a matter of what you choose. That's a personal decision for you to make. That's why I keep coming back to this point that you have to find your own style. You can't just, you read, of course, to get clarity, but eventually you have to always listen to your inner voice and find your own style. So that's basically the point. Though this is a loose point that I would make, a general point that I would make here. Now here I have a comment on page 36. There are three things. All three we have already discussed, okay? But I will just discuss something maybe a little bit more about YTM. So we have this comment on page 36. So what we said. Yeah, divide is holdings here. Okay, so that's why I made the observation about asset allocation. So you have to understand, although Graham is not using that expression, you have to understand, because these are general terms. These are terms that are used in the industry. So when you're going into the industry, you have to know these terms. It's very useful to know these terms. You can carry on conversation, then people will think you're smart. So you can say that this is really an asset allocation discussion that he's having. Okay, this is what we call asset allocation in the industry, that how much needs to be put in. And this is from a traditional asset management point of view, TAM, where we just look at cash, stocks, bonds, and cash. Cash is what you start out with. So if you're very very nervous, you don't like the state of the market either in bonds or stocks, then you have everything in cash. So that's a sign that you're very, very nervous about what's going to happen to the market, and you don't want to put your money anywhere. So that's sometimes you'll see people being interviewed and talking about, I have a very high percentage cash holding. That means the guy is very cautious. Okay, he doesn't like the state of the market. He's nervous about what might happen. And then how you divide between bonds and stocks. This discussion we've already had. So I'm just pointing out that these issues come up again on page 36. Okay, you should be able to recognize that. Then he is talking about now he's talking about dividend yield here. That's why I mentioned dividend yield. Okay, and of course dividend yield is mentioned. We've already discussed it earlier in an earlier session, dividend yield. So I just wanted to make the note here that he's talking about dividend yield. And then there's of course the other part, which is pretty simple, but the other part which is pretty simple, which is the difference. Also, you should know this I want to make sure that sometimes it may seem to the more advanced students that we are discussing simple things, but I want to make sure that everybody in the class is on board and the fundamentals are clear to everybody. So there's also this discussion between tax-free and taxable return, okay? Pre-tax and post-tax returns. That's another topic on this page, actually. Pre and post-tax, pre-tax and post-tax returns, okay? So for that, we will just go to your spreadsheet. Let's open the spreadsheet here. All right, okay, so this may be I'll just increase the zoom so you'll be able to see. So the tax rate is, these are all, percentage, okay? So your tax rate, how to figure out, so the tax rate and pre-tax and post-tax returns, okay? So basically what we write is, this is the general formula. What should be the general formula? Post-tax return is equal to, how should we write it? Anybody wants to give me a tip? The general formula, and then we'll also refer you to
Sir, pre-tax returns.
Yes.
Sir, return, this is in percentage or the amount?
No, amount is okay. You can write amount or percentage, it's the same thing.
Yeah.
Percentage means only that its amount is 100. When we are using percentage, that means, yeah, pre-tax return into what?
Into post-tax, 1 minus tax rate.
Correct. 1 minus P. All right. So this is the formula. Okay. Now, post-tax return is pre-tax minus into 1 minus T. So this is basically the formula, and we'll just show you how it works. Okay. So this is because if you open up the formula, you have the pre-tax return. Okay. Then on the, so you have the pre-tax return minus T times the pre-tax return. So basically what's happening is you have your pre-tax return, which is your gross return, and the net return here basically, and from that you have to subtract the tax rate applied to the pre-tax return. Okay. So this is what I've shown here in cell B27. Okay. Cell B27. Now, I'm not referring to the spreadsheet because we have only one spreadsheet here that we refer to. So you know that if I write something like this, it refers to your IPM 21 calc spreadsheet. Okay. So this tax rate is 30%, pre-tax return is 35%. The tax will be, right, the tax rate applied to the pre-tax return, and then the post-tax return becomes this, which is basically the pre-tax return minus the tax. And here there's a cross-check number, okay, which is using our formula. What we got using the, the dummy method, step-by-step dummy method, this is what we got. And using our formula, which is the SMART method, what do we have? We have the pre-tax return times 1 minus the tax rate. Okay, as Mayank has clarified, this is the formula. Okay, so this is meant to give you the cross-check. Okay, lots of people are leaving the meeting. I hope it's not some kind of technical problem. And I hope this is like an intentional decision to leave and not some kind of somebody's getting knocked out. All these people who are getting knocked out, we may want to just check on this. Naman has left, Pulkit has left. You might want to just check on your WhatsApp group whether these guys left on their own or were they kicked out because of some
No,
tech
sir,
issue.
I'm back.
Okay, okay, you're back. Okay. So, but when you went out, did you get knocked out or did you leave on your own?
No, sir, by chance I swiped left.
Okay, all right, okay, fine,
Yes.
no problem. Okay, so I just want, my main concern is I don't have problem with people leaving the meeting, but I just have a concern that people shouldn't get kicked out because of some tech issue of less bandwidth and all that. That's my
No,
main
sir, nothing
concern.
like that. Nothing like that.
Okay, excellent. Okay, great. So we wanted to clarify that, just make sure that everybody should be like Bank is clear about it. But just in case everybody was not, we should be clear about this basic thing. Very, very simple basic formula, but we need to make sure that everybody understands. Okay. So as you see, one of the things I focus on in this course and in every course is to make sure that the students are ready with the fundamentals. Okay. So not so much that the syllabus has to be covered, but certain basics. That's why I cross-check some of the stuff that you guys have studied in first year as well, because I want to make sure that the concepts are clear, because in some cases you've forgotten the concepts. So I have to, shake you up once again and make sure you understand. So that's one of the things. The dividend yield we have already studied before. Okay. Now, coming back to YTM, there are certain issues that he has raised here. So he has raised, 4.5% is high-grade bonds. Okay, these are they have taxable bonds and tax-free bonds also in the US. Okay, so you can directly see the rates on these two, and so these rates are these are YTMs. Okay, he's talking about YTMs. So what is happening with the YTMs? Again, what he's saying is, all right. So what he's saying is with the YTM. So let's just go once more. There's one more concept with YTM I want to make sure you understand. Okay, everybody has to understand this very clearly. Now, so this we've already discussed. I'm just repeating the definition here so that it's near our fresh discussion on YTM. The definition is clear in your head. Okay, it's a market interest rate, and it's a discount rate. You can see what YTM is over here. Okay, so the YTM here is, it's a little bit, we can maybe micromanage, or maybe I can lower make it 30, and you can see all of it together. Yeah, you can see all this prices. Now, in this case, the YTM is 4. In this case, the YTM is 5. In this case, the YTM is 3. It's a market interest rate, and what is it? Just to recap, it's a discount rate which when you use it to discount the returns from a debt security, it will produce a fair value. Okay, which is I'm writing it once again in terms of equations. RHS, right hand side of the equation, is the fair value, which is exactly equal to its current market price, which is the LHS. Okay, so you have to understand this is the peculiar case where, now I've taught you about the difference between, now typically when in finance textbooks we discuss YTM, we don't talk in terms of term expressions like fair value and market price. We do use the word market price, but we don't talk about fair value. We don't point out that the RHS of a YTM equation is actually the fair value of the bond. Okay, so this is what is important to understand. So this is the fair value of the bond. And so this is basically, what is YTM? It's a peculiar kind of a case where you are normally we would expect that the fair value is different from the price. Okay, but this is a peculiar kind of case where the fair value is equal to the price, and that is basically you keep on tinkering with the discount rate here. You keep on tinkering with this. We mentioned this before, so I'm not going to spend too much time on it. You keep on tinkering with this 6, 7, 8, 9, 3, 4, 1, 2 until you come to 5, and that's when you find that the RHS, the fair value of the bond, equals the market price, which you can independently observe. The market price can be independently observed, and it's this. This is the market price in this case. All right. So that's your definition of YTM. Now, my question to you is, there's something else you need to understand about YTM. Is if I ask you a question, what is the, in mathematical terms, or let's say in purely mathematical terms, what's the difference between YTM and IRR? It's become ITM. YTM, what's the difference between IRR? Anybody wants to say something? Let me make this really small so that you can see both of them together. Even 80 is not good. Let's make it a full screen. Now you can see, of course, you can't see it very well now because this second diagram, the figures are maybe not visible to you. Is my question clear? My question is, in purely mathematical terms, what's the difference between YTM and, you know what IRR is? You've done this while doing your project cash flows, project NPV and all that. All right. Now you remember what IRR is. You have to. Okay. So now I'm asking, and you know what YTM is. Now I'm asking you in purely mathematical terms, what's the difference between YTM and IRR? Or you can just say, what's the difference between YTM and IRR? You can make a comparison between YTM and IRR. I'm just giving you this expression here to give you a little bit of a clue. Yes, anybody wants to say something? Anyone? You're able to hear me, right? I hope, like, if the whole class has gone silent. 1 minute, there's something in the chat box also. Kirith is present. Okay, we'll deal with that later. I think that was already taken care of. Yes. Are you folks able to hear me? Can somebody respond so that I know that at least it's not that the audio has gone off?
Yes, sir.
We can hear you.
Okay, you can hear me. Okay, fine. Nobody has responded, so I will give you the answer. Okay, so the answer is, what's the difference? Answer is none, actually. Let me show you why the answer is none. So essentially, what we have to understand is that, I don't know if obviously you guys didn't cover it, either you didn't cover it in the first year, or you covered it and you forgot. Okay. Let me write it. I'll just write. Now I'll just make it bigger again. No, maybe this part I should just write. 1 second. The YTM is merely the IRR of the investment in the bond. Okay. So bond YTM, what is the difference between bond YTM and we're calling it a bond because it's paying coupons, right? So what's the difference between bond YTM and, let's say, project IRR or whatever it is? And purely, that's why I said purely mathematical terms, because obviously one is for a bond and one is for a project. So there's a difference there. Okay. And so this I can write project as in brackets, actually. Project as in brackets, because you're familiar with project IRR. Okay. Now, what is IRR? Anybody wants to recap the definition? Maybe you've forgotten this also. What is, I've given you a similar definition. Kirith wants to join. Okay. Right. Again, from outside DSP. I don't know why everybody's coming from outside DSP. Okay. Anybody wants to, like, I've given you a definition of YTM. What is YTM? If anybody asks you, this is what you should. Don't memorize it like don't memorize it blindly. Okay. Apply your mind and understand what is going on. So in similar terms, what is IRR? Again, we are recapping. Anybody wants to tell me what is IRR? Nobody.
Internal rate of return.
No, that's fine. Okay, that's fine. Yes, but what is it conceptually? What does it mean? What is IRR?
Yeah, IRR is when NPV becomes 0.
Okay,
Sir,
good.
it is
So-
a method of calculating rate of return.
Okay, good. Yeah. But yeah, so what is more important to me is that other second answer, which is IRR implies that IRR is basically, what is this? Just like this, let's copy the definition from here and let's write it here. Okay. We'll try to copy that. So make it similar. Okay. IRR is the discount rate. Okay. Now look at the definition of, look at the first, understand the project, the NPV equation. Okay. They put it in a slightly different way. Conventionally, we write the minus C0 in the beginning, and then we look at the cash flows on the project. All right. So now this minus C0, okay, is, so another way to write this equation, obviously, as you can see, is to take this C0 to the left-hand side. Okay, so that becomes when NPV is, this is what the NPV is, right? So you can say also that this will become, when the NPV is equal to 0, okay, if the LHS is equal to 0, this is what, so let's first write IRR here. IRR is the discount rate, which when used to discount the cash, the returns So just use the general word, returns. Okay. There's no coupon principle here. From a, I need to make this bigger actually. It's a discount rate which when used to discount the returns from a project. Okay. Produces a fair value for the, in this case we won't write RHS as such, although it will be, okay, eventually it will be, so we can leave this here, for the project. Okay, let me copy this project here, and so you make sure you understand. All right, for the project, which is exactly equal to its now here I'm going to write something which may seem a little bit controversial, because I'm writing that market price is equal to cost. I'll explain to you why this is. Okay, exactly equal to is, I'm going to de-highlight this market price because you're familiar with this cost part of it, right? When you've studied NPV, you studied this as the cost of the project, okay, the initial cost of the project. So essentially what we do is, if we have this, if this is the IRR, if this R is the IRR, so as just to say, IRR is a discount rate which when used to discount the returns on projects, produces a fair value for the project, which is exactly equal. We don't write this, we are not going to write this because the equation appears in different forms for the project, which is exactly equal to its current cost. Okay, we won't write LHS also here. Okay, which is the same as saying, okay, so, or we can say, or copy from here. We're just writing this down. You're recapping IRR, of course, but just making sure that you're about it. Okay, so IRR is the discount rate which, when used to discount the return on a project, produces a zero NPV for the project. Not very elegantly written, but you understand what it means. Okay, zero NPV. The key word is this: NPV becomes zero. When IRR is the discount rate, the NPV becomes zero. Now, what is the equation for NPV? Is over here. The equation for NPV is, here are all the cash flows of the project from year one onwards. When this R is the IRR, okay, or IRR is that R, which if this produces LHS equal to zero, which means this term becomes equal to this. When is NPV, when is LHS equal to zero? When in the two terms in the RHS, this one is equal to this one. Okay, so X minus X, 0. So that's why LHS becomes 0. Now, so first you have to understand that IRR is the discount rate, which when used to discount the return produces an NPV of 0. Now, 0 NPV, what does this mean? 0 LHS is equal to 0 means this one is equal to this one. Okay, what is this one here? Now, this is where you have to understand this is where you have to bring in your understanding of fair value once again. You see, it follows the general fair value model that I've given you earlier. What are you doing? Fair value of the project. What is this? All the returns from the project in every period. All the returns of the project in every period discounted by the appropriate discount rate. So you have a summation, all the present values of all the period returns, and you add up all the present values, okay, and you get the fair value of the project. So this term, you have to understand it. This is your new understanding, which you may not have understood as this when you first studied it. But this term in the NPV is nothing but the fair value of the project, because this is how you do fair value of any asset. What are the returns from the asset? In which periods? Well, show me the present value of each of those period returns. Add up all the present values. That's the fair value of the asset. In this case, the asset happens to be a project. Is this clear? Are you following so far? Yeah? Okay. Somebody, maybe I should ask somebody in particular. Then I'll get a I want to just make sure that everybody is able to hear me. Who should we ask? Okay, let's ask Kabir. Is Kabir in the room right now? Kabir is not. Let's ask Mansi. Are you able to follow what I just said? Mansi is not there. Who is there? I hope people can hear me. Let's ask Neha. Neha is also not there. Okay, let's ask Pant. Is Pant there? What happened? No, nobody is responding. Is somebody, can someone respond? Are you able to hear me?
Yes, sir. Yes, sir.
Yes, sir. We
Yes,
can
sir.
hear you.
Okay, good. So at least all the people I called, they are not present actually. Okay, never mind. So I just want to make sure that my voice is audible. So today, so far, we have not had the problems that we had in the previous session. Okay, touch wood. And so I hope that you have understood so far what I've said. Now, the new understanding that you have to have is this term in the NPV, which you're already familiar with this equation. This is nothing but the fair value of the project. Okay. So the way to talk about NPV IRR is either to say that IRR is the discount rate, which produces a zero NPV. That's good. But more than that, you have to also understand a further understanding, a deeper understanding of the NPV equation, which is that this is the fair value of the project. This term is the fair value of the project because it's just a sum of all the present values of all the period returns from the project, which is one type of asset. Okay, so here you have the fair value of the project. And what is the initial investment? Now, historically, we have always studied NPV as this term is written as C0. Okay, so it's a cost of the project. So we say cost of the project. And now here I'm writing something which may be a little bit kind of heretical for some people, because I'm saying that market price and cost are the same. Okay, but I'll explain to you why I say this. Okay, now imagine. Okay, so what I'm essentially saying is that what we refer to as the cost of the project is basically the cost of the project to the person who is not someone who's building the project, not someone who's executing the project, but to the cost is to the cost to the person who has commissioned the project, the person who wants the project to be done and who's paying for the project. Okay, so basically cost is cost to the person who's paying for the project or who has commissioned the project. Now imagine, why is cost equal to current market price? It's because, let's say, let me give you an example. Okay, suppose the Delhi Metro wants to do an extension of the metro from, say, Hyderpur to Karnal. Now, there are two ways to do it. One normal way to do it is that we'll put out an invitation to tender. And if you should remember your legal aspects of business case, Union of India versus Madala Tataya, tendering for, I think it was Jaggery. Okay, so you put out an invitation to tender, and in response to that, various companies will tender, will submit their tenders, like L&T, maybe Siemens, and this and that. Okay, so various companies will put that in their tender. Now, then of course they'll award this company. Let's say they award this project to L&T. Now L&T's tender is they are charging, say, $20 million for building this line from Hyderpur to Karnal. Okay, so they will deliver a fully functioning metro line on which the trains can straight away start running. So this is one thing, that the cost of the project now, this, if they accept this tender from L&T, then the cost of the project is 20 million. Okay, so this is how we write 20 million in the markets. Okay, so the cost of the project is 20 million. But imagine this, that this is something where instead of going through the tendering process, you have basically a bunch of people, like maybe there's some kind of a industrial fair or something, where you got all these guys. Essentially, imagine that it's possible, okay, that you can just basically create this, you can construct this line and you can just carry it with you and bring it to this industrial fair and say that, okay, here's this line. You want to buy this segment of the line? Take it. Pay me 20 million, take it. Okay. So it's just like, it's the market price of the asset, of the market price of that project, because it's what you have to pay to acquire that, to get that project executed. So because the cost is the cost to the cost is to the party, um, you know, uh, who will own the project. Okay. So when when this project is executed by L&T and they hand it over after they get their 20 million, they hand it over to Delhi Metro. It is Delhi Metro who owns the project. So we say cost C0 because it's a cost to the party who own the project, but then it's just like the market price. So if I go and buy an iPhone for 35,000 rupees, okay, now this, if you ask me how much did it cost you, I'm going to say 35,000 rupees, which is the same as the market price. Now, it's not the cost. The cost is not the cost to Apple. That cost is obviously much lower because their margin is built into the price that I pay. So once you understand that cost is to the party who will own the project. So it's just like a market price, because if it is possible to have these, big segments of metro lines, if you can just kind of collapse it and carry it in your pocket, you can come to an industrial fair and everybody's offering this. Hey, you want to buy this segment of metro line? Here it is, $20 million. You can take this. So it's like a market price. Okay. So this is why I'm saying that it is the IRR is the discount rate. Yes, of course, which produces zero NPV. But what is the further meaning of zero NPV? It means that the fair value of the project is exactly equal to the initial investment, which is the market price of the project. Okay, so basically what happens is you can take this to this side. Then what happens is that the fair value of the project is equal, this is zero. So the fair value of the project is equal to the market price of the project. Okay, so that's another way of thinking about the IRR. Okay, and this always shows you that why I gave you that price versus fair value paradigm. If you see, when you do a rejection, it applies to all these situations, because when you reject a project, when do you reject a project? When NPV is less than, or let's say you're considering only one project. Sometimes you may reject a project even with positive NPV. Okay. So now if you write this, okay, actually we should write this first, and then we'll write this. I hope you guys are not lost. Okay. If there's any confusion, you must ask me, because this is where the conceptual application comes. You have to understand conceptually what is being discussed. Okay. If there's any confusion, you have to ask me. Okay, right now I write this. Okay, now let's put it this way. Now
Excuse me, sir.
Yes, go ahead.
So what is this 20 mm?
Mm is million. Mm is the way we write million in the markets. In the in global finance, we write for is for million, is a signal for million, and M is for 1,000. Okay, so is for million. Okay, all right. So now what am I saying now? How does this relate to the price versus fair value paradigm? That also I want to make sure that you understand. Price versus fair value paradigm. How do we operate there? If price is greater than fair value, then what do we do? Do we buy or do we not buy? If price is greater than fair value.
So not buy.
Yeah, we not buy. Okay. So if I think the fair value of Alphabet is 1550, and the price now is trading at 2829, obviously I'm not going to buy as a value investor. This is why Warren Buffett was left out of the tech boom in the late 1990s, because he's a value investor and he found that those stocks were too highly priced. Okay, PE ratios of 200, 300. He was not going to buy stuff like that. Okay, so we don't buy because price is above fair value. And is price of okay. Now, so we understand this paradigm. If I will just write it once again. If we'll write short forms, okay? If P greater than FV, we have written this many times, but I'm writing it again, okay? So we're writing it from a long only perspective. Don't buy. Now, don't buy is same as reject project. You agree with that? Yeah. Don't buy is same as reject project. Okay.
Yes, sir.
Okay, and we are considering only one project. Okay, because if we have multiple projects, and one has an NPV of 20 million and another has an NPV of 35 million. So we will take the 35 million NPV project if we can only take one. That means you're still rejecting the 20 million project, but although it has a positive NPV. So that's why you see how important it is to be, whenever we are making any statements, okay, assume only one project is available for investing. Okay, that's why I'm putting this condition. Okay, if there are multiple projects, you may still reject projects which have positive NPV simply because they are not the highest NPV project. Okay, so that's why I want this assumption to be there. Okay. Now, if fair value price is greater than fair value in the stock market, we don't buy, or any other asset market, we don't buy. And the equivalent of that in project analysis is reject the project, right? Reject the project. Now that you have an understanding of what is price in the NPV framework, okay, you know what initial investment C0 is actually the market price. So when you reject the project, okay, reject the project also means that the NPV was negative, right? That's why with one project, your NPV is negative. So NPV is negative. That's why you're rejecting the project. Okay. Now let's see how whether this whole equation, the price versus fair value paradigm, can be applied to our NPV decision making, project decision making also. Okay. Are you following? Please make sure if you have any doubt, you ask me. Okay. If you understand this, you will understand the universality of this framework, the price versus fair value paradigm, how universal it is. It can be applied in every situation that you have. Okay, in every situation. Okay, so price versus fair value, don't buy. Price is greater than fair value, which is the same as reject project. When do we reject project? When NPV is negative. Okay, now go back to NPV. NPV is negative means which is greater? This one is greater or this one is greater?
An initial investment would be great.
Correct. So when this one is greater, then this one is lesser, then this will create a negative sum, a negative sum. So therefore, this will become negative. So NPV is negative. We don't we reject the project when fair value is less than price. Okay, is this right? So this is initial investment is greater. So price is greater than fair value. So you can see how it matches. Can you see that now, how it is matching? That NPV is, we reject the project when NPV is negative. NPV is negative when initial investment is greater than fair value of project. Initial investment is nothing but the price of the project. So price is greater than fair value. That leads to rejection of the project because of negative NPV. Everyone following so far? Okay.
Yes, sir.
Okay. Now you see how it fits the framework. Price is greater than fair value, we reject the project. Price is greater than fair value in the case of Alphabet stock, or in the case of anything else, euro versus US dollars, then you don't buy, or you reject the project. NPV is negative, which means price is greater than fair value. Is this clear now? Okay. Now once again, let's see the flip side also. That will make it clearer. Normally we don't have to do the flip side once we've done this, but in this case, we'll do it to make sure that everybody understands clearly exactly what is going on, exactly how the same framework is being applied everywhere. Okay, even when you don't realize it, but you're actually applying a price versus fair value framework. That's what I want you to understand. Okay, now next situation, price is less than fair value is buy, and this one is accept the project. Accept project, buy, accept project. Okay, this implies that NPV is positive. Okay, NPV is positive. Okay, let's take this NPV is positive and see whether it is the same as price is less than fair value. NPV is positive. Yeah, if NPV is positive, what does this mean? Which is greater, this one, fair value or market price?
Fair value.
Okay, fair value is greater. Okay, so fair value is greater than market price, which means market price is less than fair value. Fair value greater than market price, or price is less than fair value. That creates positive NPV. And you can see here, price is less than fair value, buy situation, positive NPV, which means we accept the project. Okay, so you can see here how we have basically the price versus fair value paradigm is always being applied even in your NPV project analysis. Okay, because once you understand that this C0 initial investment is nothing but the market price, okay, of the project, okay, of the project that, like I gave you the example of the segment of metro line between Hyderpur and Karnal. You just buy it from the market, a ready-made line. Just go and pick it up and just attach it to Hyderpur, and that's it. Okay, so it's really the or you commission somebody to do a project and there's a cost of that project. It's the same thing. It's a market price. All right, so you understand this. So now what we are saying is you have understood what we did a little bit of understanding of a different thing, which is the how the NPV decision-making framework fits into the price versus fair value paradigm. And so what we are saying is basically the YTM is mainly it's a slightly different, I kind of disturbed the logical flow a little bit, but the YTM is merely the IRR of the investment in the bond. Okay, so if you see what is IRR? IRR is one that produces of NPV of 0. Okay, which means it makes the fair value equal to the market price. Okay, NPV is 0. Move this to this side. Market price equal to fair value. Okay, this is there. In this case, if that happens, we say the R is the IRR here. This R is the IRR because it produced an NPV of 0. All right. So similarly, now look at this, the YTM. Sorry, where is the YTM chart? It's below here. Look at the YTM chart here. Let me go to F11 once again. All right. Now you see the YTM chart again. Every time, what is it? All these cases, the RHS is nothing but the fair value of the bond. And this case, the price in this case is 1,000. The price in this case is 965, and the price in this case is 1037. Okay, so what is happening here? All cases, this is the YTM, and this is the YTM because on the right hand side you have the fair value of the bond, which is the coupons, returns, and the principal returns on the bond discounted each NPV, each present value for each period. And you add them all up and you get the fair value of the project. Here you get the fair value of the bond. And that's being equated to the market price. Why? By tinkering with this. Okay. So basically now you understand that the YTM is nothing but the IRR of the investment in the bond. Is this point clear to everyone? In all these cases, we say that here we say IRR is 4, here we say IRR is 5, here we say IRR is 3. Okay. So it is basically nothing but, you have to understand that IRR is nothing but this is what the statement here is talking about. That I'm sorry, I might have made some mistakes there in terms of what I said, okay, because I'm talking so much. But let me reaffirm the correct statement, which is the YTM is merely the IRR of the investment in the bond. You understood what IRR is in a project context, project NPV context? The YTM is just nothing but the IRR of the investment in the bond. That's why in purely mathematical terms, there's no difference between bond YTM and project IRR. Purely mathematical terms means the fact that this is a project, the fact that this is a bond, we kind of forget about all that. We just look at the mathematical expressions. So it's meant to, this clue is meant to basically make you forget that one is a bond and one is a project. Okay, so now you understand. Any doubt about what I have explained so far? Anybody, any doubt? Make sure you understand all this. This will all basically clean up your brain and make sure you understand. Your concepts will become clearer. Any doubt about anything I mentioned? Comma, full stop, semicolon, anything you don't understand about what I said, please ask a question. No? We have 11 people absent right now. Yes, any question? I was hopeful that the no question. Okay, everybody has understood these things. So let me quickly recap what we have discussed in this segment so far. Okay, that is that we went into YTM, we recapped the definition of YTM. Then I asked you, what is in purely mathematical terms, what's the difference between bond YTM and project IRR? The answer is none. If YTM is just the IRR of the investment in the bond. And how do you understand that? Because going back to the definition of IRR, IRR is the discount rate which produces a 0 NPV. Another way of saying that is if this is 0, then IRR makes the fair value of the project equal to the initial investment in the project, which is the market price of the project. It makes the fair value equal to the market price. This goes to this side. And then what is happening in the bond case? Again, it's the same thing. The IRR makes the fair value on the right hand side equal to the market price on the left hand side. So the YTM, sorry, again, I made a mistake. I said IRR. I said it is actually YTM. So therefore, YTM is nothing but the IRR of the investment in the bond. Okay, so that's what we have recapped. All right. So this is important to understand for your conceptual clarity, and then we had a slight discussion on how when you do acceptance and rejection of projects, it's nothing but a price versus fair value paradigm being applied. It's the same paradigm being applied all the time. We have to understand that. Okay, so that's what we have covered so far. All right. So, okay. So next we go on to the next. We'll get out of F11. Okay. So this discussion happened on 36 because of what clue? YTM. Yeah, because YTM was being mentioned also effectively. So we wanted to have a wider discussion on YTM. I wanted to make sure that this part of YTM is also discussed. Okay, so we've got this down. Okay, now here's another idea. Get this. So when I move my cursor around, and like I'm moving my cursor around right now over the, can you folks see it? And you see that I'm moving my cursor around like this?
Yes, sir.
Okay,
Yes,
good. Okay, good. Because sometimes when I watch the videos, it seems like that part is not so clear. Okay. So here we have, that's good. Yeah. So we can highlight a little bit of it. Now, okay. Now forget about it should be pointed out. Now stock component. Now this is a new idea. Okay. This is another idea you should be familiar with because it's frequently discussed in the market. And, people sometimes implicitly assume this to be the case. That stocks, you'll hear this statement, okay, that stocks are, equities are a hedge against inflation. Okay, an equity, long position in equities is a hedge against inflation. So this is the idea that I'm highlighting here on page 37. Okay, so the question is basically how good a hedge are they? Okay, so actually you should not be writing stocks. It's better to write equities, but I've just written stocks. Maybe it's a little easier to write. Okay, word comes to one's mind a little more easily. Okay, so how good are stocks as a hedge against inflation? So for that, you can actually do a comparison. We are not going to go into that. I've given you the links, but this is basically what you have to do. You have to look at, you have to understand whether it's retail inflation, which is CPI, okay? And what index would be used to measure wholesale inflation? What index? Retail inflation is measured by CPI. Wholesale inflation is measured by what index? Anybody? What happened? Your finance students. This kind of question could also be asked in an interview. Nobody has heard of this thing called WPI? You've never heard in discussions of WPI? Yes? Anybody? CPI and WPI. Okay. These are the two indices of inflation. See, now this means that you're not doing enough reading. You're not following the instructions I've given you. You're not doing enough reading, not following the news, because these kind of, when the RBI is taking its policy decisions, they would be looking at both of these, okay, sometimes giving more importance to one or the other. But you should understand these things, that this is retail inflation, this is the wholesale inflation, let's say wholesale price index. So you must be very familiar with these terms, okay? And so I've given you, so what would you do to understand for any period? That you can just click this, look at the index of consumer prices, how it's going, and then look at the stock market, how it's going, and then see whether, or you can just look at the, do a historical analysis just through numbers. What did you realize on the stock market? What was the historical return? Kind of like what we discussed in the pricing of debt securities, the real rate of return plus expected inflation. So the answer for this question, though, is that generally you will see the market, the people talk about, the people generally say that the general conventional wisdom is that, yeah, this is what I've written here, okay, that the conventional wisdom is that stocks are a pretty good hedge against inflation, long position in stocks, okay? But actually the true answer is that you can't really be sure, okay? The level of protection, this is what I want to emphasize here. It really varies across periods. And this is what Graham is also emphasizing once again on page 38, Okay, so the question is this: how good are equities? How good is a long position in equities as a hedge against large-scale inflation? So the answer is, at the end, the answer is basically that we don't really know because it depends. It varies from period to period. Okay, so what has happened since it goes on to page 38, and he basically tells you that 64 to 71, it was not a good hedge. Okay, so this is in the US, 64 to 71. So it's country specific. It's also period specific. Now you may find some periods in the US where it was actually a good hedge. So it varies. Okay, so that's why I've said here varies across periods and also countries. So the answer, like many other answers in finance, the correct answers, which many people in the market will not tell you, the people in the market will tend to behave like, especially if they're a stockbroker. Okay, because what does a stockbroker want you to do? They want you to buy stocks. So they will find every other reason to make you buy stocks. So this is another thing that I can bet you that you'll never find a stockbroker who says that stock equities are not a long position in equities is not a good, is not a good investment again, not a good hedge against inflation. Okay, so this is not really correct. So don't buy this conventional wisdom. Let me write it down properly. Okay, the conventional wisdom is that we have to be very precise here. A long position in equities is a good hedge against inflation. And we can make it a little prettier by putting this in, changing the case. Okay. Now, not true. Okay, don't buy this. Okay, there is no like in many areas of finance. Okay, in finance and economics, you can't make these kind of general statements because many of the things don't work out all the time. Like here, Graham is giving you an example. This period didn't really work out so well. You could maybe find other periods. What you should really understand as knowledgeable students of finance, which pretty much nobody else will tell you in the industry, only I'm telling you, because many people either they're not aware of all this or they have a vested interest, like a stockbroker. He's never going to tell you that this is not true. He will always tell you that a long position in equities is a good hedge against inflation because he wants you to buy stocks. So he will tell you everything that's possible, that every possible justification he'll give you to buy stocks. So don't buy any of this. These kind of general blanket statements in finance and economics are generally not true because finance and economics is different from physics. Okay, so it's so uncertain because it's driven by human expectations and you don't know how human expectations react. I mean, who would say, like, can you imagine that in this kind of pandemic with so many lockdowns, so much economic disaster, okay, so many countries, so many people lost their jobs. Look at how the stock market is going. Look at our own Nifty. It's not like our country is doing very well economically, okay, but look at the Nifty. Look at this. I mean, who would consider this to be normal behavior? This is insane, actually. If you really think about it logically, this is sheer insanity, okay? But of course, part of the reason this is happening is because of central bank, monetary inflation. I mean, expansion of the monetary base. They're pumping up. They're basically printing money like crazy, and flooding the market with money because they're afraid that there'll be a recession. So, but can you imagine with this kind of economic devastation, which we have not really recovered from, the market is over here. Okay, so you never know what's going to happen. So this is the takeaway that you should have. No, you should never trust anybody who is giving you these kind of blanket statements that, oh, a long position is good in equities. A good long position in equities is a good hedge against inflation. Be very careful about these, blanket statement, general statements. All right. Now, there's one more element of bond market, money market confusion on page. This statement is not really correct. Okay. It's not really correct to say that the money market does not have an important bearing on the investment policy of individuals. These are not really correct statements. Money market can have massive this is short-term financing costs. That's where that's what you discover in the money market. What are the short-term financing costs? So it's not true at all to say that this doesn't have an important bearing on the investment policy of investment individuals, because in fact, what I just pointed out to you, why are all stock markets going up like this? One of the main drivers is the mad expansion of the money supply by all the central banks around the world. They're pumping out cash. They're just printing money and buying debt, buying debt securities, sometimes even private debt securities. Forget about government bonds. And in the Eurozone also, they're doing this. So it's just sheer madness. And that's part of the reason. And that affects money markets, actually. Central banks keeping interest rates low keeps artificially keeping interest rates low. That affects money markets. So this kind of statement is not correct. And again, there's a little bit of a confusion about money market, bond markets. So I mentioned this point, but we already understand now. We've done the difference.
Sir, how the government is dealing with the cost of printing the currency?
That the government is not going to deal with. That poor people will have to deal with. When you have inflation, it is the poor guy who's going to suffer. Those of us who are more or less a little bit well off, they're not going to, okay, we'll buy, maybe we won't buy the new iPhone. We'll buy a cheaper version for some new different local phone. But that's not really suffering. The guys who suffer, the cost of this is a very important question from a policy point of view, okay? That this is obviously going to lead to inflation, okay? Right now it's causing asset inflation, and it may cause inflation in goods markets also, like your sugar prices, milk prices, this, that, can also go up because there's too much money chasing too few goods. Production also is low now because of the pandemic. So this can happen, okay? But certainly asset inflation is happening. So a general answer to that, inflation is the person who gets hurt by inflation most is the common man, okay? The little guy, actually. The rickshaw pullers who are, rickshaw pullers who are actually working, who need to work every day to earn a living. Those are the guys who are getting hurt by inflation. So if you're talking about the policy cost, the government doesn't bear the cost because it's a fiat currency regime. I can print as much as there's no accountability. Nobody is going to, question the government why you're going to print, why are you printing so much money? And this is not even an election issue in India. And whether it's an election or not, every government is going to, whether it's BJP or Congress, everybody's going to end up doing the same thing because they don't really take the decisions. It's the bureaucrats who are taking the decisions in the RBI. So these guys think that, no, well, we have to hold back. We have to prevent it. We have to prevent a recession. That's why let's flood the economy with money. But that has huge consequences for poor people because inflation hits poor people the most. So this is the answer to your question is are you satisfied with the answer to your question? Yeah. Sorry, who was that? Who asked the question? Was it Meg? The question about how is the government going to pay for the cost of printing so much money? Who asked that question? Now what happened? Everybody's gone quiet now. Can somebody answer? Can somebody give me a response so that you're able to hear me, right?
Sir, yes, you are audible. Maybe he is Kanishk.
Okay, Kanishk asked the question. Okay, so Kanishk, are you there or you've been? What happened?
Sir, yes, sir, I'm here.
Okay, are you satisfied with the answer I gave to your question?
Yes, sir. Yes, sir.
Okay. So the guy who suffers basically is going to be the little guy from inflation because the government is a fiat. Remember, this is a fiat currency regime. We are not on a gold standard. If we were on a gold standard, there would be a problem because you can only print amount of money which is backed by gold, by your gold holdings. But we are not constrained like that. We are like, it's a fiat currency regime. So like Mohammed bin Tughlaq, we can print as much money as we want. So because the government is the king. So it's a fiat currency regime. So the hurt comes to the little people, the little guys like the rickshawalas. Those are the guys who are going to pay the price. So this is a classic policy problem, which is not realized in most countries. That that inflation hits the little guys the most, because in every central bank is doing the same thing that our central bank is doing. You look at any stock market chart anywhere in the world, it's the same thing. You look at the US, they're also flooding the market with money. There also you see how it's behaved after the pandemic. It's actually becoming almost stronger because actually they've been flooding the system with money since this period. Okay, so that's why it's, if you look at a European index, DAX, let's look at the German index. Not so much, but still it's going up, right? After the pandemic, it's still going up. So still pretty high up, although every economy has been hit hard by Euro. Let's look at the Euro stocks. Euro stocks 50. This is a European benchmark. Yeah, you see. Okay, so they don't have that much data on that. Yeah, so even that is going up after the pandemic. Not as much as the American markets, the US markets, or the Indian market, but everything is going up. All right, so okay, so that's important to understand. Equities as a long position equities is not a good hedge against inflation necessarily. Money market, bond market prices. Okay, another important statement on page 38, which is basically, we don't have to discuss much about it because I've already told you this, several times. That the fundamental thing you have to understand about markets is that they're not really predictable in the sense, they're not really predictable. I mean, sometimes you can get it right, but there's a high level of error, error rate. So you have to understand that and develop a healthy respect for the market. That's why your position sizing and your risk management become very important. And not that you can't make money, you can, but your position sizing is very important. Your risk management is very important. When you are losing money on a stock, you have to get out quickly. You can't keep holding on. So these things become very important. So as one of the great traders has said, Ed Sekoda, he was asked about the 3 golden rules of trading. And he said the 3 golden rules of trading are, okay, cut losses, and cut losses. Okay. So 3, I may write that here. Security prices are not predictable. 3 golden rules of trading, according to Ed Sekoda. I think I've given you market wizards in your readings. Project brief. Let me open the project brief. 3 golden rules of trading. What happened? Equal to cut losses. You understand? Everybody understands what's meant by cut losses. Cut losses means when you buy something. Okay, I'm discussing from a long only perspective. When you buy something and you start losing money, you get out. Okay, let's say if you buy Maruti. Okay, so this is our all here. Okay, so let's say you buy Maruti at this point, okay, 6950 or something. So you got to have some kind of a benchmark. So suppose it starts going below 3965, this point from where it has started rising. So at maybe not such a wide stop, but at some point you have to have a pre-calculated stop, which is before you enter the position, you must cut your losses. If it goes below this point and you start losing money, don't just hold on to it, just get out of it at some point. Okay, so that's what I'm trying to say. Cut losses means once you invest in something and it starts losing money, you have to exit the position and eat your losses. Okay, so this is the important thing. Here, given? Yeah, go ahead.
So sir, we also have option of stop loss while
Yes.
trading.
Correct. Stop loss is the way you cut your losses. The stop loss order helps you to cut the losses. Okay, that basically effectively that's what it does. Okay, I don't know if I've written this. Yeah, I think I would not have written this book name here because it's not really directly related to the project. So I'll write this book here. You can find this on the internet. Okay, it's by the same guy here. Okay, this guy Jack Schwager, same guy who's written this, Jack Schwager. Okay, same guy Schwager here has written a couple of very good books actually. This is Ed Sekoda, the interview of Ed Sekoda, the very famous systems trader. Okay, write it this here, Market Wizards. You can read. It's a very fascinating book to read. Okay, by Jack Schwager, same guy who has written that. I don't know if I'm spelling it properly. Yeah, I guess so. Whatever. Yeah, Schwager. This will be the right spelling. Okay, same guy. You can just go. You can just check on PDF Drive. I think you'll find this book, or you can find it on the internet somewhere. So this is an important point, that this is not predictable. I've made this clear to you several times, because the reason I say several times, I've said this several times, is because the general feel in the market is, all this financial modeling and this and that, and as if, finance is some kind of physics or mechanical engineering, and you can just put in some model and just do this. This is all garbage, actually, because finance is basically highly unpredictable. Economics and finance, everything is highly unpredictable. So it's very important that students are given a warning, because our job is to protect the students. So instead of giving them all this garbage, that you can sit in you can make some financial models and make some predictions and make money out of it. It's not so simple, because it's not like physics. Okay, so in physics, once you crack the problem, it's cracked, and everybody else can just copy it, okay, and just use it, and it's always going to work. Okay, so it's not like that in finance. So you need to understand that, because the reason I emphasize it is because nobody else is emphasizing it. Most people are giving you the other kind of impression, because maybe they're trying to sell you courses on financial modeling. So they have to make it appear that, this is some kind of magic formula. So, but it's very important to understand that this is all garbage. Okay, don't trust it. Follow the markets in real time yourself, and then you'll understand why the statement is true. Okay, you'll understand for yourself, and trust your own instinct. Don't believe some big shot, whatever he's saying. Just always trust your own instinct. That's more important. Okay, let's continue here, where again we are going on to page 39. Okay, which is, okay, yeah, this was not a good statement by this Graham. Okay, now again, this is 6% interest return. Again, I've just hammering home that once again, don't make this kind of statement for your own good. I'm saying, for your own future, whenever you're discussing anything related to the world of business with anybody else, be very careful when you make a statement. If that statement is not always going to be true, put in the qualification. Okay, so when you say including 6% interest return, well, that 6% was only going to be realized, okay, assumes reinvestment at the YTM rate. Okay, so this I'm writing here. That unless you get to reinvest the proceeds at the interim proceeds, sorry, sorry about that. Okay, so unless you get to reinvest the interim proceeds at 6%, at whatever the YTM is, you don't realize the YTM on the bond. Okay, that's not going to be realized. Okay, so you have to understand that. So you have to always mention that. So let's go to the last one here, which is the growth rate at EPS. This is the comment that is there on page 39, where he's talking about, so where he's talking about that, actually we've already crossed the time, but I'll just briefly mention it, then we'll start off on this on the previous, from the next session. I think we can stop here, actually. We'll start from here. I'll make a note here that this is our end of day, this is our end of day.
18th September.
Yeah, 18th September. I'll start off from here later. Okay. All right. Okay. So because we have this other important job to do, somebody has left. We only have 35 people left. We have this other important job to do, which is the attendance. We have to submit the attendance. Before that, I want to give people one more chance. Let's start from the bottom. Whoever is absent. Rohan. Is Rohan there? Either raise your hand or at least interrupt with the voice. Ritvik, he appeared in between. Oh, Ritvik is present. Okay. Okay, can you just raise your hand once? Sorry about that.
Yes.
Because we have to apply the same. Yeah. Okay, excellent. Yes. Great. So you have managed to squeeze in. Okay, good. Okay,
Thank
good.
you.
Now Ritvik is clear. Now we go to Munjal. Did he manage to get in? Yes. No, Munjal? No? Okay. Oh, then he remains what he is. Okay. So he remains absent. Okay. Then Monica. Anything? Monica, did she appear? Monica didn't appear. Manas did not appear. Okay, Manas did not appear. Then Chavi, did Chavi appear? Chavi is not here. Chetan not here. No, Chetan not here. Okay, Ankit Jain, has he appeared? No. Okay, all right. Okay, so I'm submitting the attendance now. Aditya is the first guy. Okay, so we are submitting the attendance. Yes. Okay, so let's get a message. Okay, attendance logged successfully for this class. Okay, that's great. So we had today, just a general question to everybody. Anybody had any bad experience with the audio or video or the screen sharing like we had in the previous class?
No, sir.
Okay.
No, sir.
Okay. So this is a good way forward. Then we stick with Google Meet. Okay, we are still using our official GSP ID Google Meet. So it would be better if everybody comes, because maybe if you come in with some other ID, then maybe you have called yourself Django or something like that. I don't know what name you used on your private email. Then I may not be able to identify when I'm taking the log of because here also I will get a log of who has been present for how long. Okay, because sometimes people call themselves, like your senior Rishabh Agarwal calls himself Pablo Escobar in his private email ID. So you should not be appearing as Pablo Escobar. You have to appear with your DSB email ID. Okay, so please make this have this much discipline. I'm sending the link to you, okay, by email. And if you have any problems operationally, please advise me on what is to be done. Okay, but we'll stick to Meet for the foreseeable future, for the rest of the course. Hopefully everything goes smoothly. Okay, so the class is dismissed. You can all leave, and anybody has questions can stay back. The rest of you can leave. Yes, anybody? Any questions? No questions? Okay, so I'll end it here then.
Sir,
Yes.
I have a question.
Yeah, go ahead.
Sir, can RBI print money against digital gold?
RBI print money against digital gold? No, RBI doesn't have to print money against anything. RBI can just print money. They don't have to print it against any digital gold. They can do that if they want. Yeah. So if I tell you that you can come in, it's like if I tell you you can come into class anytime you want. You can still come into class right at the start, at the beginning. Nobody's stopping you. But I have given you the freedom to come in anytime you want, and I'll give you attendance. So RBI can print money, basically, period. RBI can print money. Now, if they want to discipline themselves and print against digital gold holdings only, and digital gold is going to be, I don't know what they exactly want digital gold to be. It has to be, digital gold has to be backed by some real gold. But whatever they want, I mean, if they want to make themselves more disciplined, they can do that. Does that answer your question?
Yes, sir.
Yeah.
You did, sir.
Yeah.
Sir,
So they can do whatever they want. I mean, yeah. Go ahead.
sir, but if RBI prints money like any time, so
Mhm.
it will further lead to inflation.
Of course. What do you think? Inflation, not only inflation, you see your beloved currency. Why
Maybe
is this?
hyperinflation.
No, I'll show you something else. Yeah, hyperinflation only. Look at this. We don't even have that much data here. Look at 1974 onwards. You can see this
Yes, sir.
Indian rupee.
Yes, sir.
Why do you
Yes.
think this is happening? Because indiscriminate money printing. 1974 is not that far away. In comparison, I'll show you some other currency, which is where the central bank is much more disciplined. These guys don't have that much data, but if I maybe, yeah, Oanda should have data. I don't know why they don't have data. Yeah, they have very little data actually. But in comparison, you see a Singapore dollar, where the central bank is actually there on a kind of a partial gold standard. The central bank is much more disciplined. And of course, they are doing their monetary policy in a different way. So you see how hard, this is what you meant by, in the markets, we use a term called hard currency. This is what is meant by a hard currency. I'll show you some other hard currency. Okay, these guys have also started doing, funny stuff with their monetary policy. Yeah. But you see from 1994, 98, look at the Swiss franc, how stable it is. Okay. Because these guys also don't, I mean, they have also been doing funny stuff as a central bank, but it's still seen as a haven. So this is what is meant by a hard currency. These are hard in the sense that they hold their value against the dollar. Right? So you're absolutely right, and that's what is happening. And so there is some internal inflation also, but what is getting hit is this: when you want to go to Switzerland for a holiday, you have to pay more because your central bank is not disciplined. And this is why, because the central bank has not disciplined, that's another reason why the rupee is not freely convertible. If the rupee was freely convertible, this figure would be much higher. Okay, it may be over 100 also, because nobody would have faith in the rupee. They would all be buying other currencies. If you allowed people, that's why you see there are so many controls in India. Of course, our controls are less than China, but we still have a lot of controls on how much foreign exchange you can buy. And just to buy a little bit of foreign exchange, you try to buy, you see how many forms you have to fill in, because they have to control it, because they know that they are not behaving properly in the domestic policy market. Okay. So it's only when when I'm not doing it right, then only then do I have to put, if I'm not managing my kingdom properly, then I have to put all kinds of barriers on preventing people from leaving my country. If I'm doing a superb job of managing my country, I don't need to put barriers, because nobody will want to leave my country. I don't need to put barriers. The reason you put all these barriers like controls of bringing the money in and all that, on foreign exchange controls, is because you know that you're managing the domestic economy poorly. So that's why you know that if you left the door open, people would take their money out and buy US dollars, and the rate will depreciate further. That's why you have to put all these controls. So when people say that China and India are going to overtake the US, I mean, the US, for all its problems right now, it's still a freely convertible currency, the US dollar. You can take your money in and out anytime you want. Nobody is interfering with that. So that's why it's very difficult. Where you look at India and China, both of them, China's controls are even more than India. So these people who are controlling the flow of foreign exchange so tightly, what does that tell you? It means that they have a guilty conscience. They know that they're not doing a good job of managing the domestic economy. That's why they have to put all these constraints on the outflow of foreign exchange and all that. So yeah, you're absolutely right, and that this is just leading to inflation, of course. And look at Indian inflation. Look at how things have risen in price in India over the last several years. Whereas if you go to a country like Singapore, like I first went to Singapore in 1998, and I keep going from time to time. There's not much inflation at all. Basic food, if you look at a good meal in a food court, proper full course meal, very little change in the price, very little inflation. So yeah, does that answer your question? Yes. I hope I did not lose the audio. You can still hear me, right? There are 18
Yes,
people
sir,
still.
we can hear you.
Okay. So that's a long answer, but that's why long answers are supposed to educate you further, because I want to make sure that you have proper context of all these aspects, as these are all important questions in policy making. That why. So when people say that India and China are going to overcome the US, you should ask them, then why do India and China have so many currency controls? What are they afraid of? So if they're such tiger economies, they should open the door. Then such a tiger economy, nobody will want to leave. No, everybody will want to come in. Why are they closing the door? That's because they know that they are not really tigers. Yeah. Any other question? No? Okay. So we'll end it here then. Touch wood. We had we had a good experience today. I was horrified by what happened the other day. So we'll stop recording. The stuff is going to appear in your drive. I've shared it with you in the drive, because I may take some time to upload it to my YouTube channel. So you will automatically get it once it gets posted there by Google. Google, as we say, the Punjabi company, Google. Google will post it, and then you will get it. Okay. All right. Okay. So I'm ending the session here. Okay. You can't end this video call yet. This call is being recorded. Okay, stop recording first. Okay, 1 minute. What is it saying? I thought I stopped recording. Okay, okay. Now click stop recording. Oh, okay. Now I have to click that stop recording.